All right. Good morning or good afternoon, everyone, and welcome to today's Lawpath webinar. My name is Joel Comerford, and I will be your host for this session. How to legally pay yourself as a business owner, Part 2, Director Loans and Division 7A explained. Firstly, a big thank you to everyone who joined last week's webinar for Part 1, and thank you so much for coming back with us today. And to those who are joining us for the first time today as well, a very warm welcome. You've picked a great session to jump into today. In last week's part one, we covered the fundamentals of paying yourself as a business owner and the different methods available and the compliance essentials you need to keep in mind. Today, we're diving deeper into one of the most important and often misunderstood areas, director loans and Division 7A. So for those of you who are new, we do have a lot of people in today. So for anyone who's new, whether you've found us through a referral or this is just something you've stumbled across, who are Lawpath and what are we about? For those of you who kind of know Lawpath, maybe quickly go and get yourself a coffee. And for those of you who are new, Lawpath is Australia's leading online legal and accounting platform for small businesses. We help over 500,000 businesses manage their compliance, create legal documents, connect with lawyers and accountants on demand, and access expert advice, all in one easy to use platform at your demand. So our goal is simple: to make legal and financial support affordable, proactive, and accessible. So you can focus on growing your business with confidence and taking away all that friction for the early stages, as well as prolonging moving forward. Introduction to our speaker today. So we are fortunate to be joined by Timothy Quinn, our head of tax and accounting here at Lawpath Tax and Advisory. Tim is a chartered accountant with 17 years of experience advising businesses on tax planning, structuring, compliance, and financial strategy. He's worked at the director level, leading tax divisions and helping businesses optimize their tax position so they can thrive. What will we be covering today, everyone? What Division 7A is and why it matters for private company directors, what counts as director loans, so including common grey areas and red flags, how to structure compliant loan agreements to avoid ATO penalties, the key documentation you'll need to stay audit ready, and practical tools and tips to keeping your business safe and compliant. Now, again, for those of you who are new, we will have a Q&A at the end of the webinar. But if you have some burning questions or if Tim mentioned something that you just wanted to get a quick response on, go ahead and chuck it in the chat and I'll do my best to advise Tim throughout so he can take a bit of time out to answer those questions effectively. We also have some wonderful partner offers and some great discounts for all those who are attending today. So stay tuned before the Q&A. I'll give you a bit of information around what we have to provide and offer. And also, we will be taking this webinar episode today and uploading it to our YouTube channel. Just type in Lawpath on YouTube if you want to catch up on any old episodes. And I will be sending out a bulk email to everyone after this with the slides, the YouTube link, as well as our offers and everything else we've mentioned today. Now, there should be something else. No, you know what? I dare say that's pretty much everything I needed to cover today. So without further ado, I'd like to introduce everyone to Timothy Quinn. And yeah, please go ahead and take it away.
Thanks very much, Joel. And a pleasure to see so many both familiar faces, but also some new names popping up today. I would say this has probably been one of the most in-demand sessions that we've run since I started doing these about a year ago. And why? And why does this matter? For a few big reasons, and you can probably tell me better than I can tell you. This is a key audit trigger risk. When we're talking about Division 7A and when we start talking about director loans, it starts to get the ATO's noses up in the air. They start to smell things running afoul. For good reason. It's complex. It's difficult. Small businesses, if they haven't been exposed to it in the past, might not know how to handle it. They might inadvertently trigger these rules without having even known they existed. So why I'm asking for your attention for the next hour is so that we can all avoid those mistakes, know what to look for, and know how to sort things out. But first of all, what actually is Division 7A, rather than just the bogeyman out there that sounds very complicated? I will actually start rather than just reading off these slides. For those of you that saw my colleague Prati giving last week's presentation, part one of this series, it was by the numbers. It was this is how you can pay yourself running a small business in Australia. You can put yourself on payroll. You can pay yourself a dividend. You can take drawings depending on your entity type. All well and good. Now, if those of you listened into Prati and thought, well, I've got a devious little idea here. What about if I don't do any of those, which all have additional tax above the corporate tax rate implications? What if instead I just take the money out of my business? What if I call it a loan and I just never pay it back? Well, this was the devious great thought that I had in my first year of becoming a tax accountant. I thought, I'm the smartest person in the world. I've come up with this scheme that no one's ever thought of. And unfortunately, all of my seniors laughed at me because, of course, this has been thought of many, many years ago, and it, of course, has been covered by the government. So the government has designed these Division 7A rules in the tax law basically to stop you as a small business owner from just taking money out of your business without the proper tax treatment. So anytime a private company provides a payment, a loan or a debt forgiveness to a shareholder or their associate, it will be triggered and it will basically slap you down and say, nice try. We will not be letting you do that. The entire purpose is just to prevent the tax-free access to profits. If you follow the tricks, if you follow all of the steps, if you document it properly, there is nothing wrong with a Division 7A loan. It is perfectly fine to have a loan between a director and a company. So for the company to effectively lend you money, there's no problem. But I'll talk you through how to make sure that you don't run foul of the rules. So let's go into it a little bit more. Again, what would the world look like without Division 7A? Everyone would basically be borrowing money from their companies all the time, never paying it back, because of course company tax profits for small businesses are only taxed at 25%. And that's a lower rate than the highest marginal rates, of course, which go up to 47% for individuals. So there's an obvious incentive just to try and tax it within the company and then take the money. So who are these rules going to apply to stop them from doing this? It's not just directors and shareholders themselves. It is, of course, their associates. Knowing again, those of you with devious minds would be funneling payments out to your spouses and to your adult children. No, they'll all be captured as well. A common example that you can see, it's not just cash payments, it can be use of particular company assets, depending if there's personal use not being accounted for, and we'll run through some real good examples of that in the future. So Division 7A isn't just for cash withdrawals, for cash loans. It's the most common that I see in my practice all the time. A simple transfer of $10,000 from company PTY bank account into Timothy Quinn's bank account, and off I go and spend as I will. That is the most common Division 7A loan that we come across. But like I said, also the use of assets, particularly company vehicles, pops up, but it can be any assets at all that you are effectively giving use of without a market rate payment. Debt forgiveness is kind of the follow-up to the direct payment. It's the idea of, okay, Timothy Quinn has withdrawn this $10,000 from Quinn Pty Limited, and then I just write the debt off. I just say, well, you don't owe it anymore. Well, that is going to be a Division 7A issue for you. It can be third-party payments. Used to see this a lot, where the company would pay the school fees. Aren't we clever? We've managed to get that out of basically pre-tax money rather than after-tax money. No, payments to third parties on your behalf will be counted as Division 7A. Likewise, the in-kind benefits, yeah, again, you used to see this all the time. People have whitened up when a company's paying for home renos, things like that is a very, very common one. And it's often a side consequence when you see these big, enormous corporate frauds that turn up in the news every so often. There's usually a side effect of these in-kind benefits being provided as well. So what does the ATO think about it when they come across these improperly designed Division 7A loans? Well, they say if there isn't a proper loan agreement, and we'll go through what a proper loan agreement looks like, or if the terms are uncommercial, if you're basically not dealing with each other on arm's length, You're treating each other, you're giving each other a sweetheart deal. You're not requiring repayments, you're charging no or low interest. Okay, the ATO has the biggest rule, the one takeaway from this is the ATO will say that loan is actually going to be treated as a deemed unfranked dividend. Now, what that means is at a very punitive level, the director who receives that loan, that's a non-compliant Division 7A loan, the director will actually have to declare that amount of money, so in my example, the $10,000, as a dividend in their personal tax return. And they get none of the franking credits that would normally attach. So this is sort of out of scope of today, but obviously when a company pays tax in Australia at that 25% or the 30% rate, they get to attach a little franking credit, a little note that says, to the bearer, if you're declaring this dividend in your personal tax return, hey, at least you've got a tax credit that will reduce your personal tax. The ATO will say in these cases, too bad, we're going to declare it as a dividend, deem it a dividend, and you're not going to get the benefit of that company tax that you've already paid. So it's a bad situation to be in. We do not want to be in a non-compliant Division 7A issue. What does the ATO look at? Timing, the idea of the loan agreement. We'll go through the rules of what that looks like. Repayments, they've got to be repaid over, well, most of them are 7 years. We'll run through that as well. And they can basically ask a lot of tricky questions about how this has come about. Andrew, we'll cover off your question actually, so I won't answer it directly. We're going to come to that very soon. We're going to look at the idea of repayments over a few years. Although very, very good question. If you personally have lent the company money, is that a Division 7A issue? No, it's only the other way around. So it's only when a company lends you money. And I do have to mentally check that every time I see it on a balance sheet. You never get away from it. So we've talked about this already, but again, it's just a reminder that some of the transactions that you might think are regular and everyday and aren't a loan actually are a loan. So that can be withdrawing money for personal use, either in cash from an ATM or by electronic transfer. Likewise, paying for those personal expenses, forgiving loans, and that private use of asset. There are a few grey areas that you just need to tread carefully with. Anytime you've got company assets that you've got mixed use, so you're doing a bit of personal, bit of business, your accountant can take care of these. It's not unfamiliar, it's perfectly normal, but we do always make sure that we account for a personal use component. And if anyone is out there thinking, isn't this fringe benefits? Haven't I heard about this FBT as well? Yeah, there's a lot of interplay between these two areas. So it is just something that really we as accountants like to get our hands dirty in. What are these red flags that really stick out? The ATO has very good computer systems that with a lot of data and more data every year. The last budget, in fact, the last two budgets, there have been big increases to the ATO's ability to capture data and use it quite effectively. So these are the sort of things that will flag you in their systems. If they are just repeated withdrawals, if they don't look commercial, a $300 cash withdrawal from a pub every Friday afternoon does not look commercial. It'll start to stick out. If you've got loan accounts where there's lots of sort of what we call journal entry cycling, where things are going in and out, but there's no commercial substance to those transactions, it starts to look a bit smelly. Likewise, the sorts of third parties that would be receiving company payments, if Knox Grammar School is receiving company funds, it starts to stick out. So these are the sort of things that will get picked up pretty simply as well. Tanya's asks what trumps where it crosses over Div 7A or FBT. There's usually a specific carve out, and it depends on the type of benefit being provided. It's quite detailed, but you usually won't trigger both. It's usually one or the other. Someone else has asked, will directors' loans to businesses be used to reduce their personal tax? No, no, because you don't get a deduction for giving a loan to a company, but that's a good question as well. And we've just got one more question before we move on. If a personal has lent a company money, what would be the treatment? The question I think is probably offsetting. So maybe if you've lent your company money and then they and then you withdraw, or basically the company repays you part of that money, is it taxable? No. So if you've lent personally your company $10,000 and you withdraw $5,000, that $5,000 is not taxable. All you're doing is repaying yourself. Great questions, guys. Do keep them coming. I'll try and get to what I can. On the flip side, what is not a Division 7A loan? What are we perfectly happy with? Well, basically, what Prati talked to you all about last week, or some of you. And again, the recording of Prati's session is available on our YouTube page. But genuine salaries that are recorded through payroll, you've pressed your button in Xero that says that this is payroll. It's done what we call the STP, the single touch payroll system. You've withheld tax on it. That's not a loan. That's a salary. Likewise, doing a proper dividend and a proper reimbursement of business expenses, anything commercial at market value is not going to be a loan. This approved dividend one, watch out for it because we'll come back to it. An approved dividend is often the way that we will actually make sure in the last minute before we lodge a company tax return for a year, would we be better off classifying this as a dividend? Would we have it as a fully franked dividend? If the ATO is going to treat it as an unfranked dividend anyway, there's probably a better way to do this. So here's a recent case that's the facts are slightly changed, a bit of de-identified. The company was just a consulting firm, had a nice $300,000 turnover. It was a reasonable little business. And the director basically took out in a bunch of smaller transactions $80,000 in cash over 2 years, purely because he had cash flow issues. There was always a sort of a soft intention to repay this loan, but there was nothing documented. There was nothing formal. The ATO audit said, look, this is an open and shut. This is actually a very, very straightforward Division 7A case. Basically, there was no compliant loan agreement. Division 7A is triggered. The $80,000 becomes taxable income of the director. Tax and penalties were assigned as well. And the director had to go through and amend prior year returns. And of course, didn't have the cash up front, so had to enter into payment plans with interest as well. So, very, very common, easy, straightforward case study. Just go through some more questions. They're going fantastically well. Michael's asked a good question. You should ask your accountant about can you reclassify things you've reported as wages as loan repayments? You can, but you do to amend STP filings and basically update them. It is possible, but it is a bit complex. So you definitely can do that. We'll talk more in more detail. There's a question there about do loan agreements need to be in place every year? No, you put the loan agreement in place once for the duration of the loan, but there are repayments that must be made every year, and I promise we will get that to you. One last question about lending money to the company. The question is, if you're paying interest on that, could the interest be a personal tax expense? Tread carefully. You'd have to think about what's the intention of the loan? Why is the interest being charged? What's the actual loan being used for? And of course, as usual, if you're treating uh, the the interest as an expense in one side, you'd expect to treat it as income on the other side. And then we've got some questions here as well. If I give my personal card to the company and as a loan and take the payment, it depends. We might be going into are you being reimbursed? If you're being reimbursed for business expenses, that is fine. So we mentioned that as one of the examples. The question there was a clarification. Yes, repayments must be made every year until it's fully repaid. So you can't just you said, well, can you just do it during the 7 years? You could repay it early, but you can't just wait until the end of the 7 years and pay it off then. We'll move quickly forwards. We'll come back to some of those questions because I'm conscious of how much excellent content we've got to get through. Like we mentioned, these are the trigger points. It's for those four different types of Division 7A loans. They are triggered at the time of the transaction. So as soon as it happens, as soon as the money is taken or the forgiveness takes place, that's the start date. You don't have to have a loan agreement in place that second. There must be it must be addressed or a loan agreement put in place by the end of the financial year, and depending on the type of agreement, it'll have to be formally in place by the date at which your next or this current year's tax return is due. So we'll go into that, a bit of the nuance there as well. The timing is really important here when we do set up loan agreements. Like I mentioned, it's got to be in place. It's got to be formally documented, signed off by the lodgement date. For most companies, that will be the 15th of May. So if you did it and of the year that the tax return. So we're in financial year 2026 now, believe it or not. So that tax return for the year ended 30th of June 2026 will be due for most people on the 15th of May 2027. So if you were to take out $10,000 from your company today and it's requiring a Div 7A loan agreement, you've got a bit of time to get it documented. There's no reason to leave it that late, but you could conceivably do so. So just bear in mind, not all companies have that same lodgement date. Depending on your type and depending on your prior compliance history, your return might be due earlier than that. So don't leave it that late, particularly if you're not certain about when your um, return is due. We've got some more questions just coming through. What about loans that are repaid within a single financial year? Fantastic. No need for a Division 7A agreement. No need for interest. You're done. So that's a good one. Likewise, in fact, two questions on exactly the same topic there. So yes, if you repay the loan within the financial year, you're absolutely fine. There's a question, do you need to have a loan agreement in place when putting in a director's loan? No, not technically, not from a tax perspective. I think a lawyer would tell you differently. If you're putting money into the company, good to have a loan agreement, cover yourself off for legal purposes, not particularly needed by tax rules. There's a one last question there that I will quickly address before we move on. People pay back loans by the 30th of June and redraw again. Very, very interesting. For those of you who are accountants in the room, or those of you that have come across some of these issues, anyone heard of Part 4A or general anti-avoidance rules? They'll say that even if you're being particularly clever and doing those repayments and redrawing, that maybe gets you safe on the Div 7A rules. Part 4A comes in and says, well, what was the commercial reason for that transaction? Do you have one, or was it a pure tax matter? Was it a pure tax avoidance matter? So it's a sneaky little idea. It's a very devious little idea. Unfortunately, Part 4A would have something to say about the tax implications of that. So it might not work for you. What are these minimum loan requirements? They're pretty straightforward, he says, having worked in this area for a while. I'd say if you've never come across them before, there's going to be a lot of complexity, and you're going to be using ATO calculators to work out minimum repayments and things like that. These loans must be in writing, so they can't exist out in the ether or in your thoughts. It's got to be, either a digital thing or a piece of paper. It has to have a set repayment schedule. You must charge interest at the ATO benchmark interest rates, which are published every year. They go up and down. They sort of roughly are supposed to mirror the lending rates out there in the world. They're never really, but they used to be much lower back when interest rates were much lower or closer to zero. The ATO benchmark rates were down around the threes. They're now up around the eights and have been there for a little while as well. That loan must be repaid for 7 years if unsecured, which is probably 99% of the Division 7A loan agreements I've ever seen, or 25 years if it's secured by registered mortgage, which is very, very unlikely to see these days. And you must meet those annual minimum repayments. So it's basically a calculated number that gets you to, are we going to pay this off in 7 years? If you don't, then you trigger an unfranked dividend. Just a quick question there. Is there a threshold for that loan amount? No. Basically from loan $1, which sounds ridiculous, right? And with any of these tax matters, does the ATO care about if you've taken a $1 loan from your company? No. Is the implication of you declaring an unfranked dividend, deemed dividend of $1 going to matter? No. So there's I guess a de minimis care factor about the ATO, but we encourage from $1 that we basically get these documented and put in place properly. So what does this structure of the loan agreement look like? And I do encourage you to have a look. If you're a subscriber to any of our premium products out there on the Lawpath platform, you'll have access to our documents. We've got Division 7A loan agreements on there. You can have a look. You can adapt them for your own use. The ATO does also provide one, I believe, as well. Certainly used to. What do these structured loan agreements look like? Of course, the amount is the most important thing, and who's borrowing and who's lending. Be specific. What is the term of the loan? Of course, it's going to be 7 years, like we said, for most of them. That interest rate, either at or above the benchmark rate. You should have reference to the idea that it will meet the benchmark rate because, of course, that rate will change year on year. With that schedule of repayments for principal and interest, and it should be signed and dated. Should be nice and formal. Um, Question there relevant for the team, I think. Anthony's asked, is it best practice to have a loan account for each financial year and a loan agreement for each financial years separately? Yes, absolutely. It is going to be impossible for you to do your calculations if you bundle it all into one general ledger account. So separate account, separate agreement for new loans every financial year is the way to do it. Phil's just asked, can you have a loan over 7 years with a fixed rate? No, it's because it's got to be on the benchmark rate. You could have a fixed rate that is going to always exceed that. If you put it in at 12%, it's unlikely to fall short. So that's one way of doing it. But most of the time, you'd be pegging it to the benchmark rate. You charge interest from the date of the loan. We said, well, when do we trigger these Div 7As? Like we said, minute one, as soon as the transaction happened, not the date of the agreement. Like I said, that benchmark interest rate does change, and the annual repayments must be calculated and made by the 30th of June. I gave you the clue here earlier. What does making a repayment look like? The simplest one is putting the cash back from your personal account into the company account. That counts as a repayment. Really, really straightforward, easy to check. Secondly, probably the second most common, or maybe even the most common, a little bit more complicated, is the declaring of a dividend without paying cash. If you think of a really straightforward way of doing it, we used my example earlier of my company lending me $10,000. Maybe a good way of repaying that, say I'd like to repay that loan $5,000. I'd like to get ahead of it, I'd like to pay it down quickly. I don't have the cash personally to put $5,000 back into the company. What I can do instead is declare a dividend of $5,000 from the company to me and not pay myself the extra 5,000 in cash. So what's that? That's actually treated as, well, the company's declared me a dividend of $5,000. I'm entitled to the money, but I'm not taking it because I know I owe the company $10,000. So my Division 7A loan balance goes down by $5,000 because it's treated as a repayment. So that's a nice, straightforward way of doing it. Of course, then the issue is I've got to pay tax on $5,000 in my personal name as I've received a dividend. Daniel, we'll go into what happens if you can't be repaid, but the general rules are if the loan can't be repaid, well, it's treated, well, the unpaid component is treated as an unfranked dividend. So if you are left with, say, after I've done that $5,000 that I never declare out to myself or I never repay, the ATO will say, tough, you're going to pay tax on it like it's a dividend. And of course, it won't be a franked dividend. It'll be an unfranked dividend, so I'll get taxed on the first dollar of it, and it'll hit me that way. We'll go into a little bit what missing a repayment looks like, not just for the company. I think a lot of people get caught up on that. For you as an individual, there are serious consequences for this. So it's very, very important. There you go. It's actually written there, isn't it? So the missed repayments will trigger a deemed dividend, and we basically got to sort yourself out by the next income year. Here's a nice straightforward one. Withdrawn $100,000 in October. We've got the loan agreement created, signed, in place by that 15th of May, that magical date, just in time before the tax return was due. We charged interest at 8.77%, which is the benchmark rate for this year. The term is 7 years. The annual minimum repayment, you can do a calculator, but it's roughly $18,000. And we've tracked it all in our software. As someone mentioned, we've got a separate loan. We call it Director's Loan 2025, and we're going to track everything in there personally. Georgina has asked, do you need to include an authority and direction in the Division 7A allowing for the dividend amount to be used to reduce the loan amount? Um, no, you don't. Not from a tax perspective. It might be handy. Certainly, anytime you declare a dividend, you absolutely document it. You have your director's resolution declaring that dividend. It's probably good practice to put something in writing saying, I, as the director, will use that dividend to reduce my director's loan. It's if we were in the best practice perfect world, yes, I'd be documenting that. I'd say plenty of people don't. Quick question as we move on as well. The question is loaning your child or maybe let's just say associate $10,000, and when they default on the loan, it's given to them as an unfranked dividend. Ah, well, Brenton, is another good idea. I like the thought behind it. You'll see that children actually don't have a zero tax-free threshold. They are taxed at top rates once they've earned. Off the top of my head, it's $416. So we know that people used to love to use their children for tax benefits like that. Unfortunately, children don't have access to the same low tax rate that adults do. So it's a good idea, but it does not work in this regard. All right, so what's happened? We maybe haven't planned for it. We're in the situation here. You've already withdrawn the funds. Today is the first time you're hearing about Division 7A. You had no idea. I don't blame you. It's very, very dry. So in this scenario, if the company's already been withdrawn and we didn't structure it as a loan, here's the easy ways to do it. Like I mentioned, declare the dividend, repays it. Might be taxable, but at least you get those franking credits. Or you can repay it in full before the tax return's due. That's finished. Even though you're paying it next year, as long as you're paying it before the tax return's due, no Division say 7A issue. Finally, we can enter into that compliant loan agreement. So going through all of the requirements, the 7 years, the interest, that's one that we've resolved it. It is a way that the ATO is very happy with you to do. Again, people get scared when they hear Division 7A like you're in trouble for doing it. No, the ATO has absolutely no problems with you doing it as long as it is compliant. So, very quickly, someone's been devious on devious. I've got to stop using that word. I'm overusing it today. Daniel says, off the question of the loan forgiveness, what about if it was to an adult? So, what about if we made a loan to an adult of $10,000? That's where you'll see that it depends on who the adult is, but the associate rules will probably trigger you. I'd be saying, why are you making this loan? Was it commercial? Basically, if it's smelly, if it seems schemy, the ATO is going to have you covered under its rules. So there's going to be no tax gain to be had there. But nice thinking again. The question then is, if we repay the loan amount in full before the company taxes return, it removes the Division 7A risk. No, you don't have to calculate interest, so you're able to, if you pay it in that time frame, you're fine. And we've had that question a couple of times there, so it's same likewise. Can the director's loan be paid down through applying future business expenses and not being? No, it's. I like your thinking, Chris. That's got your lawyer's hat on there. They've got to be sort of present entitlements and present repayments. But fantastic idea. So, absolutely, the question there is if someone declares interest associated with loan payments as interest as income and they'll pay tax on that income, yes, none of these options are going to be without tax once interest has been charged. Completely correct. So we talked about these compliance deadlines already, but again, you basically got 2 points you should be looking out for. You should be looking out for the 30th of June because that's when we've got to make these minimum repayments. And then you should be looking out as well for your company tax return date because that's the last time you've got the ability to fix up or correct a Division 7A issue that has arisen from the previous financial year. And again, I've said typically 15th of May. It depends. Some companies will be earlier. Some will be in February. Some will be in October. So do check. And again, the constant standout that I should be repeating with every slide here is please do talk to an accountant. This is difficult to do on your own. As you can tell by the absolute flurry of questions we've got coming in, because and I would certainly say don't just chat GPT it, don't just Google it, and dare I say, don't just take the ATO's word for it. There are specific things that will apply to you that make a general case very difficult to give. You really need to look at this in your specific circumstances. So you need to be engaged with an accountant who knows what they're doing, who you can talk to, and who can help advise you on this as well. Jackie's asked, I think the question there is Division 7A, does it apply to trusts or is it just companies? It is just for private companies. When you're talking about trusts, you'll start to deal with what feels like a similar area of tax law called unpaid present entitlements. We've got some very juicy court cases going on for that at the moment as well. It's just come up. Someone's just asked, what about a UPE? Yeah, Bendel, old Stephen Bendel. Out of scope for today's meeting, maybe we'll do a separate one on that. But I think the idea is the same. Anytime you're giving a loan that's not being properly taxed and captured, the ATO will interpret tax law in a way that stops that from happening. How do we avoid these penalties? Because what happens if we get it wrong? The deemed dividends, like we say, the shareholders will pay the full personal tax on those amounts, and that can be on payments or loan forgiveness to associates, as we've discussed. Not just that, they can go back in time, of course, require you to amend previous assessments, tax assessments, depending on the timing of these benefits. So that's painful in itself. You think it's annoying to have to deal with an accountant once a year to do your tax return. Imagine having to reopen it and do it all again and pay more tax. It's going to be painful. Anytime you're paying late tax, of course, there will be penalties and interest applied. The ATO, for those of you who watch me regularly on this series, they know that the Bank of ATO is closed. The pussycat has grown claws. We're basically seeing some real pretty strong compliance activity out of the gate from the ATO at the moment. And I think, like we mentioned really on, the idea of these Div 7A issues coming up and being tracked, they do put you at risk of a full audit. If the ATO looks at your Division 7A and has an issue there, they think potentially the issues go deeper. Potentially there are payroll issues. Potentially there are any number of tax things that can come up. So you might get hit with a full audit on that. What I said before as well is don't just get caught up in it from the company perspective, and don't think that you can cut and run. If your company gets hit with these issues, that you can just shut the company down and be done with it. Directors are personally liable. So the impact of these laws is to shift the burden of compliance. They basically say, well, we've given you, the company, the chance to if you can't do it, we're going to shift that liability onto the shareholders and the directors. So it becomes your personal issue, as we have seen, and again for people that have followed this series a lot recently, as a lot of tax issues that tend to be going. There seems to be a strong move to push personal liability from corporate misdoings. Ross has just asked a question: do these issues apply to churches or not-for-profits? Again, it does only apply to private companies. It is a rare not-for-profit that is structured as a private PTY limited. I know there are a few out there. I can't say I've ever come across it. Um, if it's through if it's through a non-company structure, it's not going to be a Division 7A issue. Again, it could potentially be Part 4A, or it could be caught under potentially in that scenario where you've got no shareholders. If you're a not-for-profit, it'd probably be deemed salary or some other form of payment. So they'll get you somehow if they don't get you with Division 7A. Stuart's just asked, if I loan to the company, does the company have to pay you interest? No, you don't have to. So that's back the other way. The ATO doesn't care about you. You might wish to, and if it's on commercial terms, you can charge interest. But these Division 7A, again, it's only for company loans to an individual, not individual loans to a company. And someone has asked, did I say that liability shifts to the shareholders? Yes, it can. Basically, the whole idea of the deemed dividend says that, well, the company's done the wrong thing. The individual will receive the tax impact of the wrong thing because the ATO has basically given up on the company to do the right thing. How do we evolve? How do we avoid getting caught by this? We've got some best practices. These best practices are the same best practices I tell you every week. Keep your personal and your business separate. You are not going to do yourself any favors by intermingling your personal affairs with your business. It's not going to be clever. It's not going to help you. It'll just make your tax return more expensive to do for your accountant. So no one wants that. Um, and of course, we do have professional obligations not to just let things through and say, "Oh, we'll just deduct it." Do keep them separate. Keep separate bank accounts. Keep separate financial accounts. Talk to your accountant before these things arise. Don't try and do it last minute. Considering repayments. So this is you got your loan agreement in place for 7 years. Fantastic. There's going to be an interest cost, and it's going to be interest income for the company, which is going to be taxable. The interest expense to you as an individual is probably not going to be deductible. Now, that feels like an unfair mismatch, but it's due to the purpose of that loan existing. If you have just taken the money out to go on holiday or to pay the school fees or whatever it is, that loan does not exist for you as an individual for a taxable income generating reason. So there are times where Division 7A interest can be deductible to you if you are using it for investment purposes, etc. But I dare say most to the overwhelming majority of Division 7A loans, the interest is not going to form a tax deduction for you. So why would we repay these things early? If you've got the cash, you should repay it early. You don't want to be incurring these interests. If the cash is sitting in your wallet or down the side of the lounge, repay that loan. Repay it early. No more interest charges, no more administration, and your accounting fees will be reduced because your poor accountant doesn't have to deal with it. Um, you don't have the cash, like I said, you can just declare a dividend. In that scenario I talked about before, my $10,000 loan, I only declared myself a $5,000 dividend. Maybe I say, I don't want the hassle. I'll declare myself a $10,000 dividend. I'll get it all done in year two. We can stop charging interest. We can just finish it off. I'd probably be smart and I'd declare that on the first day of the financial year so as to avoid an interest charge for that year. Of course, what's the downside? I'm going to pay tax on it at my personal marginal rate. But potentially I make that decision because by the time that that's come around, the company has paid some tax, which means I've got some franking credits. So it means I can reduce that tax balance, that tax payable on that to myself. These practical files, again, don't try and do it yourself. Have a go at it. Have a look at these Division 7A agreements, but do run it past the eyes of a professional, I implore you. We talked about what these contain. It's the whole loan agreement, and basically making sure that your accounting records are up to date. That's what that means. Don't get too caught up in the detail. As with any other accounting records, you do have to keep them from 5 years from the date of the tax return lodgement. Using accounting software is almost a no-brainer. Uh, I'll say it every single webinar that I do. You'd be mad not to. Spreadsheets, with all due respect to those people that try and use spreadsheets to run company finances, they work until they don't, and then they're very, very hard to fix. Use accounting software, you're going to protect yourself from a lot of drama. Because what's your accountant going to do? They know the rules like the back of their hand. They know the structures. They know the strategies. They know what works, what doesn't. They can advise you on your repayment strategy and the benefits of repayment early and the costs of repayment early. Of course, they know all the deadlines too, so they'll keep you in touch of them and will be proactive and basically minimize all those audit risks. The audit ready checklist is, like we said, get the agreement signed and dated. Make sure it's recorded properly in your accounting software. Make sure you've made your repayments. Make sure any directors' resolutions are made where we've declared a dividend. Which accounting software, someone has asked. Whatever accounting software you like. My personal favorite is Xero. I dare say it's probably the most used in Australia today. MYOB and QuickBooks are fine. They'll do the job, and any accountant will know how to use them. But we like zero at Lawpath anyway, and certainly we offer our subscribers very steep discounts on zero rates that you can access through your portal, your Lawpath portal. What are the final takeaways here? Don't expect to know everything. Don't come out of this going, I don't know all of the Division 7A rules. Few people do. It is a complex area. Have the most important things in the front of your mind. Understand that it applies basically when you're receiving a benefit that should otherwise be taxed. If you're receiving a benefit, either the use of a thing or cash from your company, and you personally haven't paid any tax on that, it's probably going to be triggering these issues. They're solvable issues. They're not, you don't need to go run for the hills. We can help you sort them out. If you have clean records, this will be very, very easily done. If you've kept details of what's going on, we can solve Division 7A issues with no dramas. The final takeaway, be proactive, be, which is not to say don't talk to us if you've already done it, but ideally, before you start to do these transactions, talk to us because we can help advise. We, being both the head of tax at Lawpath, but of course, as a representative for all accountants anywhere, just talk to us. We like these issues, they're exciting for us. Again, avoiding any sort of personal intermingling with business expenses. We don't like that. Anytime you're doing backdating or trying to get the tea bag out and make your piece of paper look like it was written 4 years ago and burning the edges like you used to do in primary school, doesn't work. It's going to be seen through pretty quickly. Don't again set and forget. Make sure that you're looking at it every year and making those repayments. And as someone mentioned, don't think that the ATO is not going to care about you because they're this what you might think of as small loans. Division 7A doesn't exist for big public companies. It is purely for small tax-paying companies. It's by design. So your Division 7A issue, unless we're talking about a coffee here and there or a couple of bucks, it is probably going to be on the ATO's radar. This is just summing up what we already mentioned. Points 1 through 3 were covered by Prati last week. These are the most common ways of paying yourself. And then here's the risky, the more compliance and the more complex areas if you're doing division directors loans and how we deal with Division 7A arrangements at the more complex end. So the further to the right you are on this picture, the more in need of professional advice you are. Just before I hand you back over to my colleague and dear friend Joel to talk you through what Lawpath can do to help, I'll just very quickly answer a last couple of questions. Sandra has asked, what's happened if you've accidentally intermingled? Like I said, repaying it as soon as you find out, or as early as you can, is going to resolve that issue for as well. Um, we would have we got we've got some fantastic questions. Look, we've got some probably what I would call housekeeping issues about am I going to get recordings? Yes, we certainly will. You'll have access to a recording on the webinar and the slides will be there as well. So you're very easy to do that. And then, yeah, fantastic. Time to pass you back. Joel.
Thank you so much, Tim. And guys, wow, we're really loving the amount of energy you guys are bringing to this webinar. We're loving the questions. Bless Tim. He's doing his best to get through it. Maybe we need to figure out how to clone Tim. Um, I always just like to advise people if you are new, this is a safe space. No question's a dumb question. We want to facilitate an area for you guys to kind of put your mind at ease and get rid of some of these issues that have been niggling at the back of your mind. So if you have any further questions, we will try to go through the chat, but also go ahead and chuck it in the Q&A, or you can just copy and paste from the chat into the Q&A if that helps as well. Uh, let's go ahead and just get everyone's how's everyone doing in the comments? Like maybe get a yes for happy or no, how's your day gone? Let's get a bit of interaction going. There's obviously been plenty of interaction at the moment, but feedback, how's everyone feeling today? I'm not sure where you are in Australia, but over here in Sydney, the sun is out, but I am freezing, absolutely freezing. Love it. Excellent. Lovely. Rural New South Wales. Oh God, I feel for you. I feel you. So guys, look, at Lawpath, we've seen too many great businesses suffer, not because of their product wasn't good, never that, but because they spend too much time wrestling with compliance, tax deadlines, and accounting headaches instead of focusing on growth. It's the 20% of just trying to do the job, and the 80% is that compliance friction, which is what we try to do to assist you and well, we try to remove the friction for you. So in regards to our plans, we'll just focus on the accounting plans through Lawpath for just this session for now, and I'm happy to mention a little bit about the legal as well. It's in the name. Our accounting advice plan puts a senior accountant in your corner all year round. So that means unlimited calls, 30 minutes a day whenever you choose, proactive advice, and hands-on help with everything from BAS lodgements to cash flow strategy, uh, payroll invoicing, all that jazz. So you don't have to wait for problems to blow up. You can get ahead of them. And the beautiful thing about the accounting advice plan is you can choose an accountant from the team. So you have one person you can continue to communicate with. So you don't have to feel like you're talking to someone new each time. And if ever you have just logistical issues, or if you just want to have a general chat about future plans that you have, click of a button right then and there in front of you on the call is your accountant from Lawpath, same day or next day consultations. It's as easy as that. You don't have to leave the office and rush out to speak to an accountant, rush back. They're there on demand for you. In regards to our tax plan, that's where essentially your stress is disappearing completely. We prepare and lodge all of your BAS statements. We do your annual tax returns and keep you off the ATO's radar. No scrambling at the end of the year, no surprise penalties, just a clean and compliant business ready to grow. Much what Tim mentioned as well. And here's the part most accountants won't tell you. When you combine great advice with full compliance support, you don't just save time, you save serious money. As gimmicky as it sounds, it's true. In fact, businesses using Lawpath save thousands each year in accounting fees and even more in avoiding penalties and missed deductions. So if you guys are new business owners, if you've been running for at least 1 to 12 years and you still kind of feel like you're in the lower, small to medium end, and you do want to expand out, but you do feel like you're being bogged down by a lot of these accounting related issues, let's have a chat afterwards and we can see what we can do for you. Um, we're not just accountants, we're also partners. We give you time back, we give you clarity and control, whether you need to pay yourself as a director without triggering Division 7A penalties, for example, restructuring for tax efficiency, or just make sure your books are perfect before the ATO ever looks your way. That's what we're here for. Because when your accounting and taxes are sorted, you're free to do whatever you need to do, which is that nice 20%. Now, one little bit of information that I took from last week's webinar from a lot of the people who attended and I spoke to. This may not pertain to you, so don't get defensive, please. But I found that a lot of people were mentioning they were having issues with just the relation with their accountants. They were saying, I love my accountant, they've been with me for years, or it's a family friend, whatever it may be. But the issue was they're having to come to our webinars to get further information wherein they could have just hopped on a call and had that more in-depth communication with the accountant. Where's my business going? Can you help me with greater tax strategies? Why didn't you tell me so much about using these strategies to pay myself, for example? I do hear a lot of accountants are taking on a lot of work, and they have jobs to they got to put food on the table. They have jobs to do as well. But if you want a more personal relationship with an accountant, if you want to be able to call them anytime throughout the week, just get those greater strategies involved within your business's nexus, and just feel like you're more confident in what you are doing moving forward, we have our plans essentially. This is the team right here on the screen. They're amazing, all Australian based, all seniors as well. So you're not going to be speaking to someone who's just fresh out of university. These guys know what they're doing and they're going to be able to identify specific areas in which your business is. So it doesn't matter if you're a psychiatrist, if you're a tradie, if you're in NDIS, if you're, whatever area or walk of life that you're coming from, we can cover you essentially. Now, we have multiple options. If you're new to Lawpath, you can go over to our page and check out some of our offers. This is our tax plan offer. Nobody else is privy to this but those who attend our webinars. Straight up tax plan, 2688. Most people may have a tax agent who's used to charging you something a little lower. So I'm sure if you guys wanting to know why the price might be a bit high, I'm sure Tim can jump in on that. Essentially, you pay for what you get. We also have a bundling option as well. So you can get our accounting and tax plan, put two plans together. We chuck 20% off on top of that. So you can get our tax plan for $3,700 for a year. All of our plans are tax deductible. And then we also have individual options. So you can get a tax plan for its own offer. You can get our accounting plan for 1,668. Um, Always good to maybe if cash flow is an issue for you guys at this point in time, but you do want to have an accountant to speak to, you can always hop on one plan and we can upgrade you later on as well. So if anyone is interested in just having a general chat with me after this call about what your situation is, whether or not Lawpath might be the right option for you, or if you're actually interested in maybe considering Lawpath as your new accounting provider, or you just want to take over from someone else, please just go ahead and chuck yes into the chat. I will take down everyone's names and I will make sure that I can get through to you ASAP and provide you all that feedback and we can just go through what's going on with your business. Now, I'd say it's time to go ahead and jump into the Q&As. There's a lot of questions to catch up on, and I'm sure everyone's got a busy day ahead. So just yeah, chuck your name in there. I will reach out to you, and we will send an email after this with the slides, the YouTube link, as well as all these offers as well. And I should also mention one last time. I mentioned a couple of times last webinar as well. We do have a new tax plan designed for ABN clients as well. So those who haven't registered a company yet, but they still want to get like a real sturdy, solid outlook on their taxes through Lawpath, we have an offer there as well. It's usually around $1,900 per year, but I think we've reduced it down to $1,500 to those who are participating in today's webinar. So again, if that's of interest to you, chuck a yes in there and I'll make sure I can get through to you after this. All right, Tim, take it away.
Nothing's come through just yet. Thank you, Joel. That was very helpful. Please, I've got you for a little bit longer for those of you still on the meeting. If you do have any more questions, please feel free to chuck them in the chat. Again, I can't necessarily answer all of the detailed questions. I'd be remiss to give you an answer that isn't quite right for your factual circumstance. I do encourage you to talk to your accountant, and of course, hopefully make me your accountant if you'd like. But I can talk generally. So please throw any more questions you may have in. And thank you everyone for your very kind comments for those of you that have left some appreciation. It's always very nice to get that feedback. So thank you for that. Daniel's asked, what's the main difference between a Div 7A and a UPE? A Div 7A is between a private company and an individual or their associate. An unpaid present entitlement is when we're talking about trust distributions or basically trust assets being used by without proper distributions. So that's probably the simplest way of explaining that difference.
Tim, I might as well just ask, because obviously cash rules everything around us, in the wise words of Wu-Tang Clan. Um, in relation to the pricing for our plans, we do get a lot of feedback from other accountants saying, how is it that Lawpath can offer these plans at such a low price? Usually people are charging a lot more. So, let's always address the elephant in the room. We're very transparent over here at Lawpath. So did you just want to maybe touch base a little bit about how Lawpath are doing things differently, especially in pricing?
Yeah, absolutely. So, I mean, I've been in practice for a long time. I think you said 17. I'm getting older, mate. I think it's more like 18 years now. I think in traditional accounting firms, there's a lot of touch points. There's a lot of professional time that's spent doing, I guess, what I'd call non-value adding services. A lot of back and forths to get clients onboarded, to do these annoying fiddly things with the ATO, to set you up in software. And then off the back of that, you track all your time, you do timesheets, you do invoicing, you do billing. Basically, 50% of your time ends up being wasted for a lot of accountants, which is why they have to charge like a raging bull, basically to cover those admin costs. Lawpath as a platform before they did tax has been doing legal and documents for 10 or 11 years. So when we started up this tax firm, we were just able to fit right in. We don't have to do any of that administration. We have what is a very low price point, but it's common across everyone. So I don't have to go in and spend my time worrying, did we make a profit on this client? Do we make a loss? It's just not important to us. What is important to us is that we've got a team of professional accountants and all they do is accounting. They don't do any administration. They don't need to. So it basically means we can offer lower prices because their time is spent doing what they like, which is solving clients' tax issues and communicating with clients and getting good results and not any of the fiddly boring stuff that we're all bad at anyway.
Brilliant, Tim. Thank you so much.
Thanks, Joel.
Uh,
Amy's just asked a question in there as well, if I can just quickly jump in. If there are multiple small drawings taken by a director from the company, but all still paid back, yes, pay it back. That's fine. As long as you're paying back these amounts in the financial year, they got no issue with that. Good question, Amy.
yeah, everyone. I'm not sure if everyone who's thanking us are still in the call, but guys, thank you so much. We really appreciate it. You've taken an hour out of your day, and you're all very, very busy business owners. And I am going to say you're busy because I've never spoken to a single sole trader or company owner who isn't. You guys are working 6 days a week, so the fact that you're able to take 1 hour out of your day is yeah, we feel very grateful to be able to facilitate your time. Um,
I do
oh,
just
here
have
we go.
one more question. Sorry, I know we're pushing it on your time. Someone's just asked here, what about if there is a sole director and company making a profit of 50,000? What is the best dividend that we can pay? The best advice I can give you here is this is why you should talk to an accountant because it's going to depend, which is a very unsatisfying question. You could certainly declare up to $50,000 as a dividend. It depends. Do you need the money? Is it better? If you're going to need the money for the company anyway next year, declare no dividend. Fantastic. It's just taxed at 25% and you've reinvested those profits back into your company. If you personally need to make some expenses, time to declare yourself a dividend. So it's going to depend on your cash flow needs and the business's cash flow needs. Sorry, can't give you a one size fits all answer. I'd be doing you a disservice, but it's worth considering. It's worth talking to your accountant about.
Got a couple more questions here. We've got one
Yeah, if you
from
borrow on the 30th of June, how long do you have to get a loan agreement in place by the time that that year's tax return is due? So if you imagine you had done that on the 30th of June 2025, you've got until the 15th of May 2026 to get that agreement in place, assuming that your company tax return is due on the 15th of May. And we've got one more question as well, I think from Joy. If you've placed some company money into a non-business property loan account, so you've basically put it into a personal offset account, the money is always available to redraw. It is still regarded as a Division 7A loan. Doesn't matter about if the money is available. If the money has gone from a business, from a company to an individual, doesn't matter that it could be repaid. It's treated as not being repaid. Good question.
any last questions, guys? Anything you'd like to squeeze in? Perhaps an accounting related question that wasn't the topic of today's session. We might be able to chuck in a sneaky response for you if you have one.
Let's let the poor people go. They've spent enough time with us today, Joel.
Absolutely. Guys, thank you so much, Tim. Always a pleasure, mate. Thank you so much for your time and your wisdom. Everyone who's still participating and may have come late, I will send you an email later on today with all the slides and the link for today's YouTube session as well. Thank you so much, and I do hope you have a lovely afternoon.
Thanks, everyone. Much appreciated.